Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a regular guest, the man who founded ShadowStats.com, the guy that gives you the real numbers. Anytime I really want to find out how the economy is really doing, I contact him. Of course, it's John Williams, it's founder of ShadowStats.com. John, thank you for joining us today on USAWatchdog.com.
Thank you for having me, Greg.
Good to have you on. I just wanted to talk about this Jekyll and Hyde, what I call it, economy. I mean, on one side, the numbers look great on certain things. On the other side, they look terrible. Why are we getting this big variance in good news and bad news, good numbers and bad numbers? What's up with the Jekyll and Hyde economy?
Well, there's a great deal of variance in terms of the quality of the numbers, and you also have different people, different political perspectives that want to see it go one way or the other. I can tell you that one of the great examples there right now is the headline first quarter GDP that was just recently reported. Came in at 3.2%. Expectations had been all over the place, but maybe in the middle was 2.5%. I thought it was going to come in well below consensus, below 1%, eventually revised to a contraction. Came in well above what anyone was forecasting that I could see. And so I was wrong on that. But as I looked at the components, a lot of the components there showed exactly what I was looking for. We have a recession in place. It's just a matter of its playing out, and some of these other funny numbers getting worked out. The reality is on the downside, where you have mixed pressures right now. People are really concerned about the economy, and that includes President Trump, particularly looking at re-election. But he's been pushing on the economy for a long time. He's been arguing the Fed should lower rates. I'm with him. The Fed created this circumstance. They're pushing for the economy on the upside because they want to continue raising rates. Banks make more money there, and they're still trying to liquidate the problems that they created by the banking system bailout back in 2008. It's an extraordinary time. I can't remember anything quite like this. Ultimately, I'm looking at our going into a new recession by the end of this year. I see the Fed being forced into renewed easing, perhaps quantitative easing. You're seeing crazy numbers, and I can get into some of them if you'd like, just starting with the GDP.
Well, when you say that it's an extraordinary time, what do you mean by that?
Well, it's normally you get a greater consistency with the numbers, as you're suggesting, may not be there with the Jekyll-Hyde economy. It is the GDP, for example. This is for the first quarter. We had a government shutdown from the end of December to the end of January. That's where most of the numbers are put together and surveyed that start off the first quarter economy. The government, the Census Bureau, is largely shut down. Most of their numbers, retail sales, the trade deficit, housing numbers, were not gathered at the time. They had to reconstruct them after the fact. Some numbers remained in place. But imagine trying to put together a regular quarterly GDP report without having hard data in hand. Now, the Bureau of Economic Analysis, which is part of the Census Bureau and was also shut down for the duration, puts the numbers together. When they came out with a number that was at 3.2%, well above consensus, and where there are so many indications of weakness in the economy, most people, I think, were looking for a much weaker number. You look at where the differences were. Well, take one factor here. Again, this is the advance estimate. They go through three estimates on the GDP. Normally, they'd have 3 months of the trade deficit available for preparation. At least they'd have an advance trade number for the third month. When this report was put together, they only had 2 months, and a third of the growth in the GDP came from the trade deficit. And the trade deficit was showing extraordinary volatility and unusual factors in it, which have been cleared up a little bit as of Friday's reporting with the advanced trade deficit for March. So let me give you a little bit on that, because it may give us some guidance as to where things are going ahead here. The trade deficit goes both positive and negative in terms of its economic impact. If it's generally, if the trade deficit is increasing, that means we're buying more from abroad. We're not manufacturing stuff at home. Generally, it's a negative contributor to the domestic growth, and vice versa when the deficit's narrowing. That's generally a good sign because people are abroad are buying our goods. We're producing more that's going abroad. But it doesn't always work that way, and it didn't work that way here. What we saw was a very unusual narrowing of the deficit. Again, that's generally good news, and that's why some people started raising their GDP estimates as we're coming into this report. But if you looked at why the trade deficit was narrowing, it wasn't that we were having surging exports that were helping our economy at home. Instead, we were having collapsing domestic consumption. People weren't buying things. People were not buying goods. So the imports were falling off, and that narrowed the deficit. And that's not a healthy sign. The last time you saw something like that was the beginning of the Great Recession. If you look at a plot of the trade deficit, and you see it dropping month after month after month, as we've had. In fact, it was just at a record deficit, and then it starts turning up. Again, we had something like that back in 2006. The reason it started picking up in 2006 was that the consumer was in terrible straits, couldn't buy, wasn't buying goods, and as a result, the goods that were normally being imported weren't imported. So that we had a sign there that the consumer was being squeezed terribly, and that's exactly what happened here in the first quarter GDP. And it's one reason that you're going to see a weaker number, and you're not about to see a rapid turnaround in this economy.
Is this why? And I hate to break in here with you, but I heard Kudlow say we need a 0.5 point rate cut. I heard the president say we need a 1% rate cut in the Fed funds rate. I mean, we'd be from 2.25 or 2.4 down to 1.25, 1.4. And maybe is this what Trump is seeing? Is this what's freaking out the Trump administration? This is loan demand for credit cards, consumer, and other stuff, and this is 2010. This is now, and it's just crashing. Is this why they're freaking out and why they want a rate cut? Because loan demand is crashing, and that, to your point, imports are crashing, demand for goods is crashing because loan demand is crashing. Is that why they're freaking out?
Well, that's part of it. The problem is the consumer's in a terrible liquidity bind. The consumer. Let's just go back in time. You had a terrible recession that started with the collapse of the banks beginning in late 2007. The economy peaked December of 2007, and then it just crashed down into 2009, worst contraction we've had since the Great Depression. Then it starts to rebound again as they report it. And if you believe the GDP numbers, we were recovering by 2011. We had recovered the pre-recession peaks. And right now, the GDP, as reported, is something like 30% above the pre-recession high in 2007. Only problem is nothing else is showing that. You look at the manufacturing sector. The manufacturing sector crashed along with the economy, but it never recovered. It turned higher, but it's still 4% shy of recovering its pre-recession high. The housing market that started crashing before the peak in 2007. It's never recovered. It's still, depending upon the measure, 20 to 50% below where it was at the time. So that the manufacturing, the housing, a lot of that's all tied to the consumer liquidity. What's happened with the consumer? Well, the consumer is squeezed with income. And when the consumer runs tight with income, he'll make up the difference often with credit expansion. But if you look at credit expansion, and this is something that the Federal Reserve controls, the level of consumer loans, and I don't care what measure you use here, if you take it net of inflation, it shows the same pattern as the other things. Crashes, then it comes back up, but it's never recovered the pre-recession high. Now, with the recovery in the banking system, Banks were lending normally. You'd expect the consumer borrowing would be higher, but it hasn't recovered. The consumer has not been able to consume the way he or she used to, and that a lot of that is tied to the Fed. The Fed had to bail out the banks and save the banking system at all costs, but the banks didn't lend the money the way they did before. They didn't lend the money that they were getting from the Fed into the system, which could have helped revive the system. Separate from that, you don't have the Fed. Let me back off. As the Fed went along with effectively zero rates for a while, and then it started to raise rates a little bit and got them up to about 1.25% back in 2017. That was you were beginning to see some recovery in the economy. But then they decided they wanted to get the system back to where it used to be in terms of interest rates, and they started raising the Fed funds by 25 basis points, 1/4% every quarter, end of each quarter. Started December of 2017, and they went up through December of 2018, at which point the stock market effectively crashed. And what was happening, and you could see it in the numbers, was that the Fed's tightening here had put a terrible liquidity squeeze on the consumer. And the consumer was pulling back with buying and seeing all sorts of recession signals. Retail sales are down and collapsing. Housing is getting worse, not better. And the Fed knew what they were doing there. I think maybe they over anticipated how easy it would be to raise rates. They say, oh, we're just going to raise rates 1/4 point each quarter. That's not much. But what they have to consider is where the system had been for a number of years. I mean, you're looking 5-6 years. There hadn't been any interest rates really. There's very, very, very low. They got it up to 1.25%. And from that level, in a period of a year, they effectively doubled the level of interest rates up to 2.5%. That may be 2.5% traditionally not a high interest rate level, but guess what? The system had gotten used to living with and working with low interest rates. This just killed the consumer. And the consumer, again, his income was squeezed. You'll find that real income net of inflation was turning down. And in fact, Cynthia Research, a very fine group of gentlemen out of the Census Bureau, they knew what they had in the Census Bureau numbers, but there's some good material that was not being posted, reported. And what they did was they went in and they pulled out the numbers, and they now report median household income every month, adjusted for inflation. And what you're seeing now is that in the last 2 months, this is February and March, median household income has declined. This is the middle income by household, and that's adjusted for inflation. You haven't seen that in a while. The growth is slowing. Even now, we're seeing a tightening of liquidity conditions on the consumer. Number one, from income, and number two, at the credit level. You see that with the levels there. It's been that way since the economic collapse. The consumers never recovered. So if I were looking to stimulate the economy, which I think the administration is, I'd certainly be pushing the Fed to lower rates, encourage bank lending, try and get liquidity back in the hands of the consumer.
So, go ahead.
The GDP numbers show a terrible squeeze on the liquidity, despite all the happy hype of 3.2% growth.
And so you're with Trump. I mean, you think we ought to cut rates a 0.5%, 8%? Are you with Trump on that?
Yeah, basically.
Okay.
The rates have to come down. That'll improve the market psychology. At least it'll improve the consumer psychology, and loosen up the lending a little bit. You'll get the consumer back in there. The average guy is still squeezed. The average guy's never recovered from the last recession. When I say that you're seeing the industrial production, that manufacturing has not recovered. Industrial production has recovered a little bit. I think it's up about 6% off its pre-recession peak. Again, manufacturing's never hit its pre-recession peak. Industrial production did because of the growth in the oil belt. That's a positive there, but it's still well shy of 20% or 30% you see with the the GDP. But beyond manufacturing, beyond the housing sector, the other area that really has never recovered is Main Street USA. And the average guy there knows it. He feels it. It's the same reason that Trump got elected against all odds, because the system was not recognizing how painful this downturn has been. And believe it or not, it's still underway. There's still a lot of areas that haven't recovered. I'm about 40 miles north of San Francisco, where I live. A very nice town. Used to be a very strong farming community. But as I drive through town with my wife, we notice that maybe 40% of the stores are shuttered. It wasn't that way 2 years ago. And I
Wow.
get total evidence around the country. In fact, if you want to do a little experiment here, anyone who's watching this would like to send me a note on anecdotal evidence. I'll include them in a survey and get it and send a copy back to them. Do it nationwide. Anecdotal evidence. How's your economy doing? Forget what you're being told. Are things good, bad? And there are areas that are doing good. I talk with my clients around the country. Some areas in Florida and Texas have been doing well, but you see mixed pressures. Illinois is not doing so well. But I don't want to prejudice anyone's.
Yeah, I got you. I got you. You want people just to write in, no matter where they are, and say, "How's your economy, good or bad?" That's at shadowstats.com. We'll also put.
Send me an email, John Williams at shadowstats.com.
Okay. All right. All right. We'll put that. We'll put the email up. If you want the email out there, we'll put it. We'll leave it up to have you say that. What would happen if we cut rates 1%? With the dollar tank? I mean, what's going to be the downside of cutting rates a whole percentage point?
Yeah, well, that's the reasons. The Fed doesn't want the rates lower basically because of the banking system. And in fact, one reason they had pushed rates higher, and the Fed gets into all sorts of nonsense here. They'll justify their interest rates on the inflation rate, but it's based on their estimate, the core inflation rate, which they target at 2%. It was the inflation measure in the GDP.
Yeah, but between us, what is the real reason why they want to raise rates? I mean, what's the man on the street explanation? Why are banks raising rates?
They want to raise rates. They want to liquidate these excess bonds that they're holding. But they raise rates. It helps the banking system. The banking system can make more money, and their primary function is to keep the banking system afloat, as we saw how they handled the crisis back in 2008.
They want to unload these toxic assets, which, lo and behold, they're not toxic anymore, and they want to dump them onto the market. Is that right?
The treasuries are not toxic. The toxic ones are probably never going to get rid of. Those are the mortgage-backed securities. The Federal Reserve's probably going to go to their grave with that one. But it's a circumstance where, I just listened to, again, the last couple of days here. The Fed had a meeting, and the Fed chairman mentioned that it'd probably be a while before they would be lowering rates, and cites contained inflation. But guess what? If you go out and fill a gas tank with gasoline, you're finding that gas prices are soaring again, and as a result, I mean, all of last year, and I'm a big contender that headline inflation's understated. All last year, even as stated, you saw inflation rates rising primarily due to the high gasoline prices. But the Fed didn't look at that because they don't count that. That's not part of the core inflation. But guess what? If you're a consumer, that's part of your liquidity stress. The Fed may be raising interest rates because they don't see the core inflation rising, but the fact that gas prices are doubling, and you're seeing 3% inflation, that squeezes your liquidity. And on top of that, you have the Fed raising their interest rates. You're being doubly squeezed, and so you have to cut back in consuming other areas. People usually need to drive, and that's the Fed doesn't allow for that in their assessment.
And if the rate cuts don't happen soon, is the economy going to tank?
The economy is tanking,
Ooh.
and I'll contend it already has, although we haven't seen it in the GDP reporting. And I'd like to get back to that. And on Friday, we had a booming jobs report. But you know what? Very funny thing there. The unemployment rate dropped to a the lowest level in 49 years, back to 69 or so, down to 3.58%. Good news. I mean, how can you be upset with the lowest unemployment rate since the years of Richard Nixon? The problem is that the other unemployment measures and other things reported with the unemployment rate show a rapidly rising level of labor stress. Along with all these happy numbers, in the last 3 months, the labor force has declined. The number of people employed has declined, and that's very unusual in a growing economy, let alone a growing population. Usually,
Where do they go if they declined? Where do they go?
yeah, they're they're stretched. They're now being discounted as counted as discouraged workers, or they may be working part time for economic reasons because they can't find a full time job. They like a full time job, but they can't get it. And if you look at the most recent numbers, the number of discouraged people have risen. The number of people marginally attached because they're working for they're working part time for economic reasons, that increased markedly.
So
But
what's the real, and you do a real unemployment number the way it was done in 1994 and earlier. What is your unemployment number? Not 3.5 or whatever it is percent. What's your number at shadowstats.com?
right now I'm at 21.2%. The headline number out of the government's 3.6%, 3.58%.
So if it was done the way it was done in 94 and earlier by the Bureau of Labor Statistics, the way they did it, it'd be
Yep.
21, it'd be north of 21%.
That is my estimate of what it
Wow.
would be if they still did it. They don't report that number. The broadest number they report, they call U6. And there they include the discouraged workers. That's now at 7.3%. But the big difference here is that back in 1994, when NAFTA was coming into play, they redefined the unemployment rate. And where you had discouraged workers, in the 1994 redefinition, they redefined discouraged workers. This is someone who couldn't find a job, they'd like to work, they've given up looking for work because there are no jobs to be had. They redefined it in 1994 that after a year, if you were discouraged, they just didn't count you anymore. Before that, they'd continue counting you. And
You continue to count them in your numbers.
huh?
You continue to count them.
That's correct.
And what would be happening? I cut you off. What would be happening in a normal expanding economy? I cut you off at that point. You said normally in an expanding economy, what would be normally happening? And not you wouldn't have discouraged workers and 21% unemployment. The way
Well,
you do it.
you'd at least see it dropping,
Ah,
and that's not happening. But what's unusual here, and what tells you that there's something real screwy, is that the stress levels, and these are traditional, and these are the numbers that come out from the government. There are two popularly followed measures of labor stress. One is the employment to population ratio. The other is the participation rate, which is the ratio of the total number of people employed plus unemployed to the labor force. Both of those are now at 7-month highs, or 7-month highs in level of stress. Lows in terms of ratio, the lower the greater the stress. What you're seeing there with both those measures are levels that would be consistent with a peak in recession activity, not a historic low in the unemployment rate, which is what we're seeing. And if you use my numbers and allow for the fact that they've got more people out there who are unemployed that would like work, you'd find that it pretty much accounts for the differential.
wow.
If you invert the scales and look at the government's headline unemployment against mine takes the same course as the levels of stress. And that's what's missing here in understanding the stress is that you have a fair portion of the population that has been unemployed for a long time and is not being reemployed, and they'd still like to. If they could get work, they would take jobs.
What's going on in the gold market? I mean, you ought to see. You're talking about the well, we're going to talk about this too. We're at another debt ceiling. We've surpassed it. They're living on borrowed time. Why is not gold going up instead of being hammered downward? What's going on in your estimation with the gold market? Just
Well,
off the top of your head. I mean, no really heavy analysis. What do you think's going on with the gold market?
right now you have a number of factors in play. If you go back to the end of December when the stocks were crashing, what you saw was the dollar was weakening, and gold was rallying along with the weakness in the dollar. The dollar over time preserves the purchasing power of people's wealth and assets. I don't care what your currency.
The
If you
gold, you mean gold does over time?
holding physical gold,
Yeah.
you take your dollars and you buy gold and you set it away over time, it'll preserve the purchasing power of your dollars. As we've all seen, some of us painfully, you have some big up and downs in gold, but guess what? Over time, it works, and it works better than anything else.
Huh.
I can demonstrate that because I have an alternate measure on inflation over time. They really gimmicked the inflation number to understate it so as to cut people's Social Security benefits. It was deliberately done that way, as expressed by people in the Fed and the administrations back in the 80s.
What's the real inflation rate while we're on that topic? Your inflation rate, what is it?
Right now, it's up around 9%.
Wow.
And so that's only because the headline's so low. But here's the thing: if you took $100 purchasing power in 1900, $100 in gold and $100 worth of dollars, and then looked at the same purchasing power of 1900 today, the gold would still have $100 in purchasing power as it did back then. I mean, which would be a tremendous amount in today's dollars. And I'm telling it this way because I don't have the inverted number in my head right now. But the dollar, $100 in just U.S. dollars, as it was in 1900, today would have purchasing power in 1900 4 cents. So you effectively had a hyperinflation over the last century plus. The paper dollar has been continuously debased by inflation, where gold has maintained its value. And if you plot them against each other against over time, you plot inflation, the headline inflation number, against the price of gold, and you'll see that the gold goes up like this, but inflation only goes up like that. But guess what? If you use my inflation number, which is what I estimate inflation used to be, I mean, it would be if they used the methodologies in place in 1980, also goes with the gold. It covers gold. Gold covers the actual purchasing power of the dollar over time, irrespective of the inflation games they play in reporting. So it's in terms of ups and downs, you have it. The value of gold is preserving the purchasing power of your wealth and assets over time. There will be ups and downs. Hold it through it, and as the dollar becomes worthless, which it will, and you were mentioning the budget deficit. The U.S. Treasury just published its annual financial statement through the GAO. Used to be the General Accounting Office. Now it's a Government Accountability Office, which tells you something perhaps of what they're doing there. But they put into it they assess the future value of all the programs, particularly Medicare and Social Security, but they cover the whole system. Put out financial statements on the U.S. government, and the summary. I mean, I'm paraphrasing here.
Okay.
I'm not paraphrasing is the term that the Treasury Secretary actually used. And his comment was, "Our fiscal policy is not sustainable. It has to be addressed." Now, and you may have heard similar terms like that in the last 6 months. The Federal Reserve Chairman Jerome Powell made the same comment, but he also indicated that this wasn't really the Fed's business. The Fed concentrated on the near-term business cycle, but yes, these things had to be addressed because it was not sustainable. The problem is that the You need something in excess of $100 trillion, and there are all sorts of estimates out there. But in hand today to be solvent going forward, you have the big uh, entitlement programs, and they're not really entitlements so much because people have actually paid taxes on this stuff for Social Security, Medicare, and such. Uh, but those are the programs that are out of control, um, and the politicians have to find a way of bringing that into long-term balance if the U.S. fiscal condition of the U.S. dollar is going to survive. Otherwise, you're going to end up in a hyperinflation. And I've used that term before, but let me be a little more specific on that. Back in, I think it was 2009, Standard & Poor's downgraded the U.S. Treasuries. There was an argument in Congress at the time about the funding the deficit. There was some threat of maybe a default. And with that, I mean, the rating agencies have to look at default because their opinion is as to the risk of there being a default or no default. And that increased the risk of the default to the level that they actually had to have a downgrade. Now, at the time, former Fed Chairman Alan Greenspan made a comment to the effect, well, that's ridiculous. There's no risk of default for the U.S. government because all the government's debts are in dollars, and we can print as many dollars as we have to. And he's right. The U.S. can do that. And to my knowledge, there's no default clause in U.S. Treasury securities about not having a hyperinflation or the dollar losing its purchasing power. So that effectively what you're going to end up doing here, and this is what's happened time after time, and I don't see anything in the current political system that's going to prevent it here, but hopefully cooler heads will prevail and we'll find a way of bringing this under control. Unless you can bring this into balance, which means raising taxes effectively and cutting expenses or benefits on Medicare and Social Security, the system will become bankrupt. It'll get to the point that, yes, they'll just print whatever money they have to meet their obligations. And that's what you've seen in Venezuela and Zimbabwe, and you saw it in the former Republic in Germany. You end up with a hyperinflation that eventually becomes worthless, and that's where you want to have the golden hand. And this is a crisis that can break, and it's recognized. The Fed chairman's mentioned it, the Treasury secretary's mentioned it, but no one in Congress is doing anything to bring it under control. That's where the risk is. That's why you want to hold gold long term.
They're worried about this a debt ceiling. I mean, the Treasury. I had this on my weekly news wrap up. Treasury retains auctions says extraordinary measures about debt limit will be exhausted in the next 6 months. So this is not something way far into the future. Mnuchin's, the Treasury Secretary, is worried about this right now. What you're telling me is that these guys are worried about default or calamity right now. Am I wrong?
Well, there are people who are indeed. The problem is that you get 6 months down the road, and are we going to default, or are we going to, given as we usually do, and increase our debt ceiling and debt limit? Maybe someone will force them to bring the system under control. But the way that's worked time after time after time is that rather than let the country default, we just raise the debt ceiling and we're going to we'll maybe have a committee study it for 5 years or something. You don't have forever on this, and the problem is that when the global markets begin to give up on the dollar, which they can do at any time, that can accelerate the process. This really needs to be addressed, and the fact that you're getting mention of it from both Treasury Secretary and the Fed Chairman, maybe something will be done. One can hope. I wouldn't make a big bet on it, but I would certainly hope so.
Well, let's not hope. Let's just talk about what happens to the dollar if we don't get a debt ceiling. I mean, can the dollar take some hits here in the fairly soon? Could the dollar, lose some purchasing power and get tanked on the global markets and the world stage?
That's always a possibility. There's a lot the government can do to support the dollar. The Fed can raise interest rates. The Treasury can ask for intervention and get it. It's
those all sound like bad choices. Raising interest rates,
Well,
printing more money, intervention, QE. Those all sound bad to me, John.
they are, but they will tend to they can stabilize the circumstance for a little bit. The problem is you need if you can bring the U.S. government into fiscal balance, long-term solvency, you don't have to worry about this.
Yeah. Come
The
on,
rest
John.
of the world, the rest of the world will buy into it, and they'll happily invest in dollars.
There's 22 trillion in actually known debt. We've got the 21 trillion Dr. Mark Skidmore came up with of missing money. Then they made the budget's dark, and so I mean that doesn't sound good. It just sounds to me like we're not. There's no happy. Oh, if the government can only get it together, well, that ain't going to happen. So let's forget that. Oh, maybe they'll. Let's forget about maybes. What it looks like right now is we're headed for some sort of a default calamity, hyperinflation. Am I wrong? Am I misreading this?
Well, eventually we are. We also have an election year ahead of us, and I'm not saying that the global markets aren't going to respond badly to it, but my betting will be that the Congress will find a way of covering this or pushing it down the road a little further. They're kicking the proverbial can down the road, which they keep doing, and at some point you go off the cliff. Um, we're approaching that point. I don't know that it's now, but it will. You've got to watch the global markets. If the global markets start rejecting what the U.S. government's doing, they do heavy selling on the dollar. Um, that could that could force it.
If we make it to past November of 2020, in 2021, do you think the rubber is going to finally hit the road? The pie is going to hit somebody squarely in the face. The whatever is going to hit the fan. Do you think in 2021 is that your drop dead date for okay? Here we go. This is it. Or am I getting this wrong? I'm not trying to box you into a corner.
They're going to keep the way I read it, and we're dealing with a political system here, and if anything can be concluded from what you've seen in the last year of operations in Washington, is that we're dealing with a very heavily politicized system. Um, Nobody wants to do anything that's going to cost them votes, and they're afraid that if they cut back in this area or that area, that they're going to lose votes. Um, you have to have the public scared and the public demanding a change. I don't think that's going to happen until you have a great financial crisis. I can't tell you exactly when that's going to be, but there will be something that will come out of this with the dollar or such where there will be a great crisis, and all of a sudden people say, okay, we got to do something. What are we going to do? I would hope they would move before that, but the track record here is we just keep pushing it as far down the road as we can and leave it to the next guys to handle.
And just as in the Forrest Gump movie, how Forrest used to say in all these little points in his life, and then one day it was over, just like that. Is that what we're going to get to? One day we're going to wake up and the world's going to change.
Well, it's the ultimate thing here is that you have a collapse in the dollar. I mean, I talk about a hyperinflationary collapse. Your purchasing power becomes worthless. What you have in the way of gold or canned goods or hard assets, those will be your assets. Real estate, hard asset. But at that point, you're going to be looking. They'll throw the bums out in Washington. I can't tell you what kind of a government you're going to end up with. If it's not been taken care of at the point that it actually gets to the financial crisis, that's basically what you're going to face. And how it breaks in between then is a matter of very fine politics and pressures with people you don't even probably have in place yet. So it's tough to call. Other than it has to be addressed. That's recognized. Hopefully they'll be doing something later this year. I hope you're right. They need to. I mean, the longer they wait here, the more difficult it is to bring it into balance.
Could war be a black swan? Some war card, Venezuela, Middle East, Iran, sanctions, closing down the Gate of Tears Straits, the Bab el Mandeb Strait, the Hormuz Strait, some sort of military action in Venezuela where China and Russia and Cuba and everybody else is involved, Iran. Could war be the wild card that tips the whole thing into the toilet?
I'm sorry, I didn't quite get that.
Could war be the wild card that
Uh,
tips everything into the toilet? Things are so weak, so tenuous. I mean, you got the president asking for a whole point rate cut, a 1% rate cut on the Fed funds rate, which effectively cuts it in half. Could war be the wild card that puts everything into the toilet?
it could be. On the other hand, when you have war, usually people rally around the country and the president, and um, to the extent that people have control of panics and such like that, or times to push. Um, I don't think that would be the time they'd be pushing. They wouldn't want to be pushing a financial crisis at the same time they had a military crisis. Um, I think
Well,
it's
they might have the choice. You may get a financial crisis if you get a military crisis. That's my question. Would we get a financial crisis if we get a military crisis?
you could. Again, it depends on circumstances. Normally, though, um, from what I've seen, military crisis people will tend to rally around the country and do what's needed. So maybe that'll help bring things in balance. I don't know. If you have a military crisis, you're going to need probably more spending for the military. You're not going to be able to fund it better than you are now. Um, Again, things get backburnered if they can at all do so.
John Williams, your prognosis for the economy of the rest of the year. Are we going to get more QE? Are we going to get a rate cut before the end of the year? Is that your prediction?
Despite what seem to be real happy numbers, at least for the GDP and the employment, um, underlying weakness is there with the consumer. Until the consumer gets turned around, you're not going to have a fundamental change in the economy. The economy is going to get weaker here. The Fed's going to recognize that. They probably already do recognize that. I think they have an internal recession forecast. They don't want to. They don't want to lower rates, but I think they're going to have to. I would look for easing by September, and maybe even quantitative easing if the economy continues to deteriorate as it seems to be doing. I know the numbers aren't there yet in the headlines, but watch out.
Okay, John Williams, you are the founder of shadowstats.com. You're an economist. You're one of my favorite guests. I know it gets a little dry talking about, but you got to get in, into the sandbox and get granular on what they're doing with these numbers, and you sure did that for us today. John Williams, thank you for being the guest for the early Sunday release. Good luck with your poll by email. You put your email out there. John Williams at shadowstats.com. Your subscription service. You have a subscription service. How much is that a year?
Well, it's I maybe have a new feature here that since we last talked, among other things, non-subscription. Anyone can go to my homepage, and when a new economic release is out, within 2 to 3 hours, you'll find a posting on the homepage that gives you an assessment of that number. I mean, I look at numbers a little differently than others do, so you might pick up something there. I also have my regular newsletter service, which is $175 a year, $89 for 6 months, and always happy to pick up new subscribers.
Yes, I know you are, and I know it's well worth it. It's very, if anybody who hasn't ever seen one of these reports, if you're investing money, if you're doing whatever, and I don't get paid for this, you just have you on. It's very detailed. It's super detailed. You get your money's worth. John Williams, thank you so much for coming on USAWatchdog.com. John Williams, shadowstats.com. Thanks for being on, buddy.
Thank you, Greg, very much.